In the midst of all this craziness, many people are still waiting for gold to fall off 30-40% like in 2008 in a market crisis. Is this a crisis like 2008? To be determined. But gold is in a very different macro setting now. It is a tier one reserve asset. It is a safe haven. US IOUs are not. And yet people are still waiting for a dramatic pullback in gold to understand it. How can you help people understand that this is a different world now and that gold is a far better savings asset and tier one asset and reserve asset than an IOU from a broke Uncle Sam?
Gold is dominating the markets in 2025, with its record-setting performance highlighting investors' flight to safety amid mounting concerns over tariffs, the economy, and inflation. The metal has surged 28% this year, vastly outperforming the S&P 500, down 9% year-to-date. Even U.S. Treasurys, traditionally considered nearly risk-free, have struggled to maintain stability amid ongoing market volatility. Meanwhile, broader economic challenges persist. As America grapples with a silent but severe credit crisis, new data reveals the deepening strain on households. Nearly 1 in 4 U.S. adults now carry unmanageable debt, defined as being forced to choose between paying off debt and covering necessities, according to an April 1st survey of 1,000 respondents. These growing financial pressures continue to stand in the way of proper fiscal stability. Matthew Piepenburg argues that today's market resembles a massively inflated balloon waiting for a needle. He emphasizes that the root of the current crisis is not tariffs, but a much deeper debt crisis, and warns that the desperate measures being taken now are far too little, far too late. According to Piepenburg, physical gold is not a speculative gamble, but a historical, mathematical, and logical safeguard. He stresses that owning gold isn't about getting rich quickly, but preserving wealth and avoiding financial ruin. Join us as we explore the video in depth. Remember to subscribe and click the bell icon to stay informed about our latest updates.
This market has been a huge red inflated balloon just looking for a needle, or a bug looking for a windshield. And it could have been any number of potential triggers or catalysts or needles, a black swan event, a geopolitical event, a war, a bank failure, a rate policy failure. But, you know, at the end of the day, markets, which we've always thought were Fed-driven and easy money-driven and rate-driven and frankly central bank-driven, whether you look at Rome or you look at more modern capital markets, every market crisis is ultimately a liquidity crisis. There's just not enough liquidity. And let's be clear, when you're in debt up to your ears with 37 trillion in public debt and a debt to GDP ratio of 125%, you're a debt-soaked nation. You're a desperate nation. So you have a debt crisis. And a debt crisis is really just another name for a credit crisis. And a credit crisis is, of course, a liquidity crisis. And without getting into all the history, but just in recent memory, let's not forget it wasn't that long ago. In 2019, we had a repo crisis, which was a disaster. That was just a credit crisis. In 2020, the markets tanked by over 35%, but for unlimited QE, which followed. But the COVID crisis of March 2020, Egon, was just a liquidity crisis. And then, of course, in 2022, we had the higher for longer policies of Powell to quote unquote fight inflation. That failed. And we had the worst nominal returns in stocks and bonds since 1871. That too was a liquidity crisis driven by the bond market and debt markets. 3 of the 4 largest bank failures in U.S. history, that wasn't even a banking crisis. That was a liquidity crisis driven by a credit crisis. And here we are, April 2025, looking at tariffs, and it's tariffs. But no, it's no buyers for our U.S. Treasuries, no liquidity, no GDP, no P in the GDP, no tax receipts enough to cover debt. So we are desperate. The tariffs are desperate. And there is again, sadly, a massive disconnect between the real economy in the U.S. and what was a ripping, seemingly immortal stock market up until a few days ago. And I think now, because markets are showing their weakness, people are actually realizing not only do we have a market crisis right now, we're in a recession. And I won't get into all the weeds, the proof. I've written ad nauseum about it, and it's only getting worse. I mean, retail sales are negative, for gosh sakes, and bond spreads, all these things. The recession indicators are overwhelming. overwhelming. Americans, and certainly American politicians, the vast majority of them have zero understanding of history and economics, let alone the Constitution, ironically. Just don't see this. And I think that's what's very scary. Again, every crisis is a debt crisis, which becomes a credit crisis, which becomes a liquidity crisis. This is nothing new. Sadly, Pavlovian investors still think the next 10 years, very few asset classes. You and I have seen this with family offices looking to unload their private credit pools, which are the new weapons of mass destruction. Tier 4 status, there's no real market or liquidity for them. The S&P is far too overvalued and volatile. But all this debt and this idea, this fantasy that the debt isn't a problem because the central banks or the government or the Fed has our back is a misunderstanding of history. Because if no one's buying that debt and productivity doesn't surpass that debt, or tax receipts don't surpass that debt, or income, you have a massive problem. And that can only be solved through chaos and desperation. The tariffs are a form of desperation. The Bitcoin strategic reserve is a form of desperation. All these desperate measures are a form of desperation, but inevitably, we're looking inward, as Ray Dalio said, because there's massive shifts now. Geopolitically, the dollar is no longer U.S.-centric. Trade with de-dollarization, the rise of the BRICS, all of which have their own problems, but they're moving away from the dollar. The indications that the U.S. and the U.S. dollar and U.S. Treasury, now weaponized, are no longer the center of the world is obvious. It's no longer safe within our own border. It's going to be debased and inflated. And even politically, there are so many changes. So we are absolutely aware of history in motion right now. It's hard to see when you're in it. But these are not just headlines or themes. De-dollarization, debasement of currency, debt as a destructive tool for all history, sound economics, and unsound disasters, which we are seeing now. And again, this is ultimately not a tariff crisis, although the tariffs are a disaster in a lot of ways. It is a debt crisis. And these desperate measures are the response to a debt crisis. It's a far little too much too late. And as I've said many times, Santa Claus, Mother Teresa, 5 Nobel laureates are not going to solve this debt crisis now. And I think these tariffs are going to make it more volatile for the markets. I mean, the VIX at 53 and counting. It's incredible. Treasury's not being overbought. It's incredible. People need to look at the history of markets, the history of tariffs, the history of debt, and they'll see that the only solution is going to be debasement, financial repression, higher currency destruction, more desperate measures geopolitically. Even a reset has to have credibility. All of these things point towards physical gold. This is not a gold selling your book, preserve your wealth. This is not a speculation, get rich quick asset. This is a don't get poor, don't get exploited asset. Playing the old game like history doesn't change. Well, history's changing right in front of us.
JP Morgan forecasts that gold prices will surpass $4,000 per ounce by the second quarter of 2026. Fueled by rising recession risks, escalating U.S. tariffs, and continued U.S.-China trade tensions. As the primary driver, the bank points to strong investor and central bank demand, averaging around 710 tons per quarter. However, JP Morgan cautions that a sharp drop in central bank demand or unexpected resilience in the U.S. economy could lead to a reversal, potentially prompting the Federal Reserve to act aggressively against inflation risks. Do you believe the era of the US dollar being the world's center of trade and trust is ending? Do you see gold as a defense strategy or a growth strategy? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.